Hi, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about tactical asset allocation versus strategic asset allocation. So when you first look at these two terms, you might say, well, what is the difference? Or is there a difference between tactical and strategic? And yes, there is, in fact, some very big differences between these two approaches. I would say probably the most common approach that's out there is strategic asset allocation. We, however, use a tactical approach to the portfolios that we manage here in our office. So by the end of the video here today, I think you'll have a pretty good understanding of the differences between tactical and strategic, and maybe make some determination as to which approach you think might be right for you and for your portfolio. So let's dive right in. Let's first talk about strategic asset allocation. And again, this is going to be the more common of the two approaches. Basically, with this approach, they're going to build a asset allocation portfolio and put different percentages in different asset classes intended to be aligned with your individual tolerance for risk. And then periodically, what they'll do is rebalance those positions. And basically what that rebalancing entails is selling things that have done well and putting money into things that haven't done well, with the intention that over time they want to keep that balanced out pretty well there within those asset classes. So they believe in diversification, buying a little bit of everything. We'll talk a little bit when we talk about tactical and what our approach is with that, but they're going to buy a little bit of everything. All the asset classes are probably going to be represented there. It relies very heavily on a buy and hold approach, and because of that, it relies on investor behavior that, in our opinion, might not necessarily be realistic for a long run. So let's take a look at this, and what do I mean by that? So if you think about the market, and the market's going to have its ups and downs, and hopefully over time it's going to have a trend that's going to go in an upward direction. So with a strategic asset allocation portfolio, all they really care about is that long-term trajectory, and they want to keep you fully invested in that asset allocation through all of these ups and downs. And again, that might be very difficult for the average investor to do. And let's think about this and what's going on here. As the market is maybe going up, and we have a moderate portfolio, let's say, we might at some point maybe feel a little bit left out. We might think, oh my gosh, the stock market's doing so great, and I see my friends are making all this money, and maybe I should take a little bit more risk with the portfolio. And of course, we all know what happens is the markets do go up and down, and we go through periodic corrections. And what we know, based on seeing the inflows into different mutual funds and the money that's flowing into the market, that a lot of people tend to put money into the stock market near the top of the market, maybe right before the market might be heading down. And at some point, as the market's going down, we might think, well, maybe that was not a great decision. I'm not comfortable with that level of risk as we're watching our portfolio go down. And eventually, at some point, we may decide to throw in the towel and sell out of some of those investments. And again, one of the major premises of the strategic asset allocation is that we stick with that allocation through all of the goods and bads. And getting that level of risk right and matched to your portfolio is probably one of the most difficult things to do in human behavior. We feel left out when the markets are doing well, and we become very risk averse when the markets are not doing well. So one of the things there to keep in mind with that. And where this really kind of comes into play, and one of the things we look at here, is the long-term movements of the market. And everyone talks about the stock market having a long-term average that might be close to 9 or 10% over time. But when we look a little bit more closely, this is a chart here of the Dow Jones Industrial Average, and looking at something called the structural markets of the Dow. And although we think of these markets in long-term averages, we can more often characterize this by these bull and bear periods, represented the bull markets in the blue, and the bear market periods represented in the gray. And some of these bear market periods can last for quite a while. Some of these 17 years, 16 years, 17 years. We just actually went through one right here with the financial meltdown, where we saw a 10-year time period where the market essentially went sideways. It was referred to oftentimes as the lost decade, and now we're back on an upward trajectory here. So I think when we see this chart and realizing that there's going to be some of these bear market periods, it really kind of makes the case, in our opinion, of why we may not necessarily want to just have a buy and hold long-term approach. When we look at different asset classes and sectors of the market, we see kind of the same things happening. So if you turn on the TV today, probably every couple of commercials, you're usually seeing a commercial for somebody encouraging you to buy gold and talking about, how gold has been this great long-term investment. It's been one of the best things over time. But when we look at the history of gold, and we can go back to the early 80s there, where gold hit $800 an ounce in 1980, and really for 20-some years, didn't hit $800 an ounce again until 2008. So if you had owned gold and it made that a part of your portfolio, you were really kind of left out. That was really kind of a dead asset class. And how many people would have had that fortitude to stick with that over that long period of time? And then it did have obviously a big run up here, and now it's been a little volatile all over the place. But it hopefully is showing you the case for why we might want to have certain asset classes or certain sectors of the market excluded. So I think most people probably recognize that there's a need for a strategy that can adapt to these changing markets. Most people, however, are unsure exactly how to do that. So that's where tactical asset allocation comes in. And what we do with the tactical asset allocation is we allow for a tilting process essentially within these asset classes. So we can have more money in stocks at maybe sometimes in the market cycle, and we can have less money in stocks at other times. We also do some rebalancing with individual sectors and things like that. We'll talk about that here in just a moment. We also have the ability within our portfolios to raise cash. So sometimes maybe just being out of the market and just having the money on the sidelines is perfectly acceptable to us depending on what our strategy and what our indicators are suggesting there. And again, asset classes and sectors can be either eliminated or completely reduced. So if energy is not doing well or utilities aren't doing well, we don't have a requirement that they have to be part of our portfolios. We can either drastically reduce those percentages or eliminate them completely. So how do we do this? Well, we use a process known as relative strength. And if you think about any professional sport, there's going to be some type of a ranking process that's out there. Whether you're talking about the PGA Tour and you're talking about which golfers are at the top of that list, or you're talking about college football, as we're looking at right here, there's going to be a ranking. This is the AP 25, I think from a year or two ago for the college football conferences there. And if we wanted to make a determination and say, okay, well, if we were going to make some predictions on which teams were likely to win this coming Saturday, we would maybe look to this list and see which teams are already ranked. And those teams that are ranked high are teams that are already winning, that have shown that they can win and that they have good strength of schedule and all those factors that go in there. They're maybe beating teams by a lot. And so generally speaking, if we make predictions on the teams that are at the top of this list, beating the teams that are near the bottom of the list, we're going to have some pretty good luck. And that's kind of what we do with the portfolios that we manage here. So here's how it works. If we look at a moderate portfolio, just as an example here, we might target that portfolio to be 60% stocks and 40% bonds, but we have the ability to go on either offense or defense. So an offensive tilt might be that we have 75% stocks and maybe 25% in a combination of bonds, maybe some international in there as well. But a defensive tilt, we might have that completely reversed. We might have over 60% of the portfolio split between cash and bonds and a much lower percentage in stocks. We have that ability. We have some mechanisms that tell us when to do that. And then we kind of take that a step further. So when we look at the portfolios that we manage, the first piece of that is going to be how much goes into those asset classes, how much goes in stocks versus bonds. We also want to look at something called size and style. So if we look at this, this is actually for 2017, and we look at what's done well. We can blow up this thing. I think, I can't do that. Oops. So we look at 2017 and we look at the full calendar year. We can see that large cap growth did 30% that year. Small cap value did 7.8%. So, in 1 year, we had a huge difference. So if we had an equal representation in those asset classes, it probably watered down our returns there a little bit. Whereas if we maybe did a little bit of overweighting towards that growth side of things, and we look at even mid cap growth and small cap growth, those were the categories that did really well. So again, kind of like that college football ranking there, the teams that were at the top did well, and the teams who were at the bottom didn't do as well, and that's the same thing that's going on here. We take that also into individual sectors of the market too, so we can look at things like financials, real estate, materials, technology. So last year, the big winner was technology stocks. It's going to be hard to read there, but it was up 38% in 2017. The big loser was energy was down 1%. That's a huge difference. So as we're looking at this, if we can overweight some of those areas of the market that are doing well and underweight or eliminate the areas of the market that are not doing as well, we think that can add some pretty significant value to the portfolios that we manage. And then the last thing that we do is once we say, okay, we like stocks, we like certain sectors or styles of the market, now we want to look at the individual security selection there, and we're going to look at things known as factors that we know have led historically to long-term good returns. Things like price to earnings ratio. We know that historically low PE stocks do better than high PE stocks. Return on assets, companies that are showing that they can invest their money and make a return off of that. It's very, very important there. Price to cash flow, price to book, and then momentum, which is kind of some of our relative strength indicators there. The stocks that are doing well tend to continue doing well until they don't, and then we make those changes there. So how do you know if your portfolio is strategic or tactical? So one of the questions that you might be asking yourself, well, I don't know. I think my advisor is making some of these changes, but how do I know for sure? Well, there's a couple of questions that you can ask. Probably one of the biggest ones is, what is the portfolio's ability to raise cash? There needs to be a mechanism in place, we believe, to, at sometimes during the market cycle, have more money in cash in the portfolio. We have some trigger mechanisms that need to happen in order for that to go to those cash positions, but you need to understand what that is, and is your advisor going to do that? And it needs to be non-subjective, so it just isn't going to be, well, we'll make changes when it's appropriate or when we think we need to do that, but there's no mechanism or trigger point that's going to make that happen. So, and again, what are the specific triggers that would substantially change the asset allocation? So something like international, is that going to be something that's going to fluctuate over time, or is it always going to be a set percentage of the portfolio? So right now, in a lot of our portfolios, we're drastically underweight international because the U.S. market is doing so well. That could change at some point. That probably will change at some point. But those are the things that you want to look at there. And then, will the portfolio exclude certain asset classes? So certain areas of the market, as we just looked at, are doing very well. Other areas of the market are not doing well. Do you have that representation in all of those asset classes, or have you made a conscious decision to eliminate or drastically reduce some of those areas? So I hope that helps. But if you want to learn a little bit more about the process that we use for building our portfolios, it all starts with a financial plan. We believe very strongly that having a plan, understanding your cash flow, understanding what your long-term goals are, is very important to building a portfolio, so we know and we can balance off the risks of cash flows and withdrawals that you might need to take from the portfolio. But if you'd like to talk to us about that, you can set up a free introductory call with us. That's with me, actually. And there should be a link right below the video there that you can click on to set that up, or you can call the office at 248-731-7829 and set up an appointment with me. So anyway, I hope this has been helpful. If you haven't already, please click on that like or subscribe button depending on where you're watching the video. We've tried to make our website very informational, so we've got our blog there, and we've got a lot of, we think, very good topics that can help you with your path to retirement and to investing. So thanks. I'll see everyone back in my next video. Have a great day.